Hey guys, we're back. The Holy Macro Show. This is where we talk about just about everything in these markets. Whether we're talking about oil, whether we're talking about equities. Like so many people are like, Jason, you're a commodity guy. Jason, you're a bond guy. Jason, you're a currency guy. Like it's all the fucking same to me. I can't really think of it any different than that. Like it's all exactly the same. People want to put people into a box, and really, it's like trading wise. If I'm going to buy equities, I'm probably buying some commodity. If I'm going to short something, I'm probably buying something else. Like it doesn't matter to me. I look at it all exactly the same. I love the commodity cycle because it also helps me to understand where to be positioned in the equities going forward, where to be positioned in the bond market going forward, or the currency markets. And so you guys have seen this chart a million times here, which is gold. It starts to move in commodities, and copper leads oil. Copper's been just ripping lately. It struggled a little bit. It made new highs. Got the Trump kick. Basically went down quite a bit. That was shortly after Liberation Day. That was sometime this summer, I think, right? August. I don't even remember. So at some point, all I remember is that copper broke out, had a very strong breakout. I think it was up 10%, kept moving higher. Then basically Trump came out. I forget even the piece of news he mentioned, but then copper got smacked down 20% in a day, bottomed out right there, and then it's been moving higher slowly ever since, and now it's kind of making a big move. So that's really good. But the thing that hasn't done shit is oil. And so oil basically is the one that's just been laying there flat. Hey, good morning, Mark. Good job, Wavy. Proud of you. But basically, if you're looking at oil, it just hasn't done anything. It's just kind of sat there flat. It's been a very boring trade. It's been a hard trade. A lot of people have hated the trade even. But really, now we're kind of seeing some things to be a little bit more bullish on it. We started seeing them at the end of last year. The crack spread started widening, meaning the distillates, things like gasoline, heating oil started moving up in a big way pretty quickly. That was towards year end. And now we're coming into next year, and it looks like some of these things are ready to move higher. We're seeing some new 52-week highs in things like ExxonMobil, which is the biggest stock in the XLE. Is it still the biggest stock in the XLE? You'd probably know this more than me, Kashap.
I'm not sure, but
Yeah.
I guess so. Yeah.
I feel like it. I mean, it was forever. If somebody wants to check that and leave us a little message in the chat, just
So
double check
so
that.
it
Go
has a
ahead.
500 billion market cap. Next is Chevron at 322. So yeah, I guess that's the biggest still.
Okay, it's still the biggest. I mean, it was the biggest stock in the S&P 500 for a while too. Like it was a big stock in our market. Now it's been smaller and smaller as energy has become a smaller weighting of the U.S. Stock market. It's a very small weighting now, which means everybody's basically underweight this, which is why you're not going to see this thing trend like it used to, where you basically have retirement accounts investing in ExxonMobil every single week. That's not going to happen anymore. Now we're in a scenario where all those investment or retirement accounts are invested in things like Apple, Microsoft, Google, because they're the biggest stocks in the S&P 500. Most of the retirement accounts are just pumping money basically into the S&P 500 through different avenues. So energy is not much of a weighting in there anymore, so it doesn't even matter for the energy market. However, this is where the alpha and the outperformance comes from. If you guys remember last year, you look at gold miners, you look at metals and mining, all these things that are very small weightings or even non-existent weightings in the S&P 500, things like uranium. These are all moving in a very big way last year. And so that's where you're going to get your alpha and outperformance is looking into these smaller sectors. And now we're kind of seeing it possibly showing up in energy. Kashap, I wanted to ask you, the oil scenario, we got Venezuela, we have all these things going on globally currently at the moment as it pertains to the oil market and Donald Trump, our president in the United States. So what are you thinking about, the energy market currently? Do you think the Venezuela situation changes anything? Do you think it's something that we're going to continue to go into different countries and do kind of a similar thing? I saw some rumors about Greenland recently as well. So what are you thinking here?
So it's a resource wars, right? It's resource nationalism. Now, if you go back to the World War II era, what did the United Kingdom do? Well, they came to the Middle East, they came to Africa, they started looking for oil, and now all the oil discoveries have been made, and what is Trump doing? Well, he's doing the same thing. He's going to Venezuela looking to take over their oil reserves. And why? So the biggest component to inflation which people don't realize is the oil price, because that goes into everything in the economy. Now you control the oil price, you can make the Fed print more money without increasing the apparent inflation that people see in the supermarket. So that's what he's doing. Plus, it's also the Monroe Doctrine, where Trump wants to supersede James Monroe and make it the Trump Doctrine. So he wants to take over Venezuela. He wants to put out a bigger clout everywhere, whether it's South America, whether it's Greenland, pretty much every part of the world. And I think it's going to backfire massively, but that backfiring is some years away. So for now, if he really wants to control the oil price, take it down to $50 by pumping massive outputs from Venezuela. So here's the thing. So Venezuelan oil, Chevron, I think for the last 10 years or something, Chevron has been getting a waiver every year to operate in Venezuela, even though it is a sanctioned jurisdiction. Now that Trump has taken over pretty much, Chevron has a green light to pump oil as much as it wants. It's like, imagine if the Russia-Ukraine war starts and ExxonMobil, which has a big Sakhalin project in the Russia, so they say that Exxon's going to operate freely, take all that Russian gas and give it to Europe for at a subsidized rate. Then how does that work? Well, that depresses the gas price. Now if they do that with oil, with the Venezuelan oil, then Chevron can pretty much control the oil market, right? Not control in the some in terms of how OPEC controls it, but in terms of how they can really ramp up the production. They can take the sanctioned oil into the white market, the legit market, and they can start competing with barrels coming out of the other areas. And if that happens, then yes, you could see oil prices going lower. And it's something similar we saw in 2014 when Saudi Arabia and the US Permian, the back end, all these guys, they had this huge price war where they all overproduced and flooded the market and oil just crashed. So I think there was a crash from $110 to $40 within 6 months. So it was a pretty quick crash. So you could absolutely see a similar situation play out in Venezuela. But that is not my base case scenario. And the reason it is not my base case scenario is this is all new. This is just 1 week old. And we as market participants, we see the news and we want to react immediately. If you see, let's say, Ukraine getting hit by a nuclear missile, not that I want that to happen, what do? Well, you buy wheat because that's the quickest trade that you will place. But the world doesn't react that way. The world is going to take time to react, and we will have to see what the long term impact of this is before we can factor that into the oil price trend. So for now, I say we just wait and watch. And I know that's a frustrating thing to say, that you just wait and watch as though you're not doing anything. But sometimes not doing anything is also doing something, in that you're watching the market, you're not saying this or that right away, but once you see something happen, you're quick to react. And it's what I've been saying with Japan for all these years. Like, once we see 160 in the yen, then we'll know it's time to act. But until then, we just watch. So I say oil, we just watch.
Yeah, I agree. I think it's you got to look at the price action. For me, I made a big call this week. Just basically, to me, something that always sticks out about certain situations is these type of big news events. If anybody's seen, I actually had a list. I should put this back up on my channel at some point. But I had a list that I would randomly share that's like all the different trades. I know you've seen it before, the different types of trades I take. And there's news setups, news failure setups. And that's basically, I want to say that's probably 2 or 3% of my trades per year. It's very low. Not many happen. But looking at the Venezuela situation and kind of seeing like that news came out and then the oil price was actually up on Monday. That's very surprising to me. Not because I think that it changed the whole situation fundamentally. I think because looking at that and just the news and Donald Trump being able to just kind of come out there and be like, hey, gasoline should be under $2, and then it would just smack the oil price. Or, he could say anything. We're pumping more oil, drill, baby, drill, whatever the hell he said. We basically got this lower oil price every single time. And then finally, like, hey, we took over Venezuela, the largest reserves in South America. and then the oil price was up the next day. To me, that's kind of saying something, not to mention something that's also significant about the price action. If you're looking at XLE, we've been talking about the divergence there for a while. Why is oil all the way down near the lows? And then if we're looking at XLE, it's hanging out near the highs. I think I brought a chart of XLE too. So it's hanging out near those highs like that it's been stuck in. And then if you go back to oil, it's hanging out near these lows. So it's like it looks very different. It's a very different setup. So what's the reason there? Well, what I think is always somebody knows something in the markets. It doesn't show up in what you're going to see a CEO say. It doesn't show up on the news. No analyst is going to figure it out ever. But it can show up in the price action at points where it's, hey, this might be beneficial for the energy stocks quite a bit. This might be a good thing for them. Granted, there's a lot of hoops that they have to get through to basically make this happen. But at the same time, looking at it and going, there's a possibility somebody out there knew something, on top of the fact that we had probably the biggest news failure event of the year where that news came out and the oil price didn't go much lower. I'm kind of getting very bullish on oil right here. I think it's a good time to take a small trade in it. Now, once again, small position, the stop isn't that far away. Not usually like my normal trading style, but sometimes these setups do come into play. Think of 2022 in October 2022. You had a big news failure event. The worst CPI ever came out. And at the same, not ever, but in that year, it was basically every CPI report that came out, if you guys remember, it would just smack the market every single time. Every single time it would get a rally, CPI would come out, smack the market down. Finally, we get the worst rate of change CPI report of the year. And then, bam, the market basically bottomed in 2022 and then never looked back. So this is kind of reminds me of that same type of setup here where this is probably as crazy of news as you could ever get for the energy market. Everybody is very mispositioned here. Everybody is short, whether I'm looking at the oil futures, gasoline futures, heating oil futures. I'm looking at XLE. I'm looking at OIH. I'm looking at the individual components, the stocks inside of it. Whatever I'm looking at, everybody's a little bit mispositioned. So I do think that this is a time where we could possibly see this energy trades really start to move. But for me, it's really going to be predicated on, can we get oil back above that 75 handle? Can we get XLE to actually break out here and not only make new 52-week highs, which it's at those today, but actually get above these levels here, getting above at now it's 50-50, I think is the here. And then if you go to 2016, I think it's $51 now is that high. So, if we can get above those levels, I'd be very interested in energy here. I'm already interested, but I'd be more interested.
Yeah, I think that's a good way to play it. For me, I do hold one energy stock in the portfolio. I'm not thinking of adding any more right now, but if we do get an higher move in oil, say 4-5% day, then I would probably be interested.
We had a 4% day yesterday, Kashab. Aren't you? Are you long as hell now?
No, I mean that was just a bounce from the bottom. Let it let it get about 60, then we'll see.
Yeah. I think we're getting close. I think it's getting close to some sort of movement. It's just something like there's no real real reason to front run it. We're not looking for here. I'm not looking for a small trade of 5-10%. I had somebody bring up something currently, and I feel bad that I didn't answer them, and I'm bringing it up now. Sometimes I'll read things like somebody will send me an email. It'll be like I'm half asleep reading it. I'm like, I'll answer this in the morning. Then I'm just going to forget about it because that's me. But they asked about the intermarket analysis. I don't mean to do that. Feel free to hit me back up if that ever happens, or just put a question mark in there because it'll bring it back up to the top of the list. But if we look at, he asked the question, which was, I thought it was a great question. How do you look at the intermarket analysis to understand how to trade? And they said they, are really don't like intermarket analysis because it doesn't tell them, how to trade, and they've lost a lot of money doing this. And so here's the $1 million question and answer. So that's the question. The answer is you don't trade on intermarket analysis. it gives you information. It can be a filter, it could be something you use for certain reasons, but you never want to make your trade solely based on a chart like this. This is telling me that oil, this because CRB commodity index is mainly energy. So this is telling me that oil can move higher. We have a massive band squeeze over a long period of time. Possible breakout to a new high that could happen. But until that breakout really happens, until this thing really starts to move, the intermarket analysis is just telling me what can happen. And then I would go to something like this to just tell me where I want to enter. Like, everybody's going to be different on that. They could look at the intermarket analysis, then go through the fundamentals and then pick it like that. I'm a person who's going to look at the technicals after the intermarket analysis and the macro analysis and understand the technicals are going to give me my entry. And they're also going to give me my exit. So I think that's the way I look at it. Hopefully you're watching out there. If you are, feel free to send me a message. But once again, I thought that was a great question. And I just want to answer that today because it pertains to the oil trade, which is it ain't pretty. It ain't pretty. But the intermarket analysis is telling me that it could be. And then the energy sector is telling me if I'm going to take a bet on it, this is the area to take that bet. And how to express it is going to be in energy stocks. OIH is looking even better than XLE at the moment. So I think, continuing to look through these sectors, continuing to understand the intermarket and the macro, and then diving in and taking the signals like that is going to be how to play it. So, Kashop, you mentioned you have an energy name. What sector are you looking at inside of energy? I actually brought a chart of this too. What sector are you looking at inside of energy to really take that trade, express that bet?
So I'm looking for something which has natural gas and infrastructure exposure. And the reason for that is I really don't want to own an oil producer right now. So I have tried this trade getting long the oil producers. I tried it in 2023. It worked briefly. I tried it in 2024, 2025. It did not work. And this year, I'm not really going to play that. So let energy start to rip and then I can add a producer. So right now I'm looking for something which is natural gas related. And the reason for that is you need natural gas for power. And with AI the way it is and so much data center construction going on, there's going to be a lot of demand for domestic produced gas. And on the other side, there's also going to be a lot of demand for LNG. And the reason for that is the Russia-Ukraine war. So Europe is shooting itself in the foot saying no to Russian energy, which means they import the US LNG at a premium. So what this is going to do is it's going to be a structural tailwind for natural gas for a long time to come. Now, yes, I could own the natural gas producers like Equity, EQT, Antero, all these stocks, but I was looking for something a bit more balanced, which has exposure to a lot of areas in the space, and I found that. So that's what I'm holding. If I'm looking at oil services stocks, right now, that's a area that it's going to be a tough call. So on the one hand, the US producers can just be like, we are going to shut down drilling. We are just, going to forget about it and the industry can get into a decline because at these prices it's really hard. Or there could be a resurgence where they say with better drilling technology, and that's what you see happening. The break even levels on the oil fields are falling, and the reason for that is technology is improving. So with better AI techniques, you could see some of these companies, the oil services companies, start to do well even in a declining market. So if that happens, I would want to own one or two of these names. But right now, it is really, really difficult because the difference between deep value and a value trap is not that apparent right now. So, what I mean by that is a deep value stock is something where the stock is priced at a terrible level in terms of price to book or it's making losses, but you can see the industry turning around, which will change the game. And a value trap is a stock that appears cheap on a PE or a price to book basis, but then because it keeps destroying shareholder value, it just keeps declining in price. So it's very hard to tell the difference, and right now it's very difficult for me to tell that difference. So I'm just staying away.
No, I get it. I think it's going to be very important to. Oh, sorry guys. Oh, that stayed up. I don't know how that worked, but anyways, It's going to be very important to be patient here. I think that's the thing that I've been trying to communicate the whole time, even though it's, everybody always goes back to this chart, which is going, oh yeah, when oil, Jason, and it's like, I don't know. Like I don't have the market doesn't do what I want it to do. I'm telling you that this is how the cycle usually works. I'm telling you that historically this makes sense. And also, I think it's still going to happen, but also I've mentioned a million times, it's like 14 months. It could be a while. So the timeline really comes to this year and even Q1, Q2 this year when this thing starts to move. I think for me, this is kind of the make or break point, but we want to see it, like Kashop mentioned, in the price action. We want to see it show up, and I want to see XLE ripping. I want to see some big movements. I want to see a gap out of this area with, let's say a 5% move, even to a 10% move. I think that's the thing that you're going to want to, nobody's going to want to buy it. Remember this, Kashop. You'll remember this very clearly. This was the bottom, back here. Now, granted, though, if this is the candlestick chart, you'd see that this almost went down to this low as well. And so this day, there was like, I want to say like 15%. It was a huge move. And no, it was right here. Nobody wanted to buy this thing. Nobody in the world wanted to buy energy stocks at this point. It moved too much. You've already missed the move if you buy it here. And then we had, basically peak performance for energy out of the spider sectors was the outperformer for a very long time, all the way into 2024. Basically, through Biden's entire term, energy was the best spider sector in the market. So once again, like, don't be afraid if this thing makes a big move to just buy the damn thing. Like a lot of people, like there's an old phrase that like older traders would always tell me, like when you're like, oh, I don't know about buying it. My system's telling me to buy this, but I don't feel like I should. This is before I used buy stops and really or automated my system quite a bit more. And they would say, no, you just got to hold your nose and buy it. And like, I think that's the scenario we're going to be here, which is, let's say we start to we gap above 51 or something. If that happens, just buy the shit out of this thing. Run a long, wide trailing stop, let this thing run. Like, we're not looking for a 10% move here. This thing could move 100% over a year or two. It could move even more than that. The subsectors will move more. The stocks will move probably even more than that. So these are all things that you have to pay attention to. And so here's a good question today, Kashop. So could you guys share your experience of last year's April crash and how you managed your positions? So, Kashop, how did you manage your positions during that time when you have, Donald Trump coming out and basically liberating everybody from profits for a little while? So what did you do there in the market at that point?
Yeah, so at that point, at the lows, my portfolio went in the red. So that erased all of my year's performance. But the good thing was because I had both long positions and short positions, and the short positions threw out some cash, I was able to increase my long exposure from little around 100% to little over 130%. So I bought a lot of stocks, just spray and pray kind of approach. I bought a lot of stocks in oil services, in dry bulk, in the gold space, in the energy space. And once the market recovered, that worked out very well. So that's how I played it. And the reason I was able to play it that way is because I had some stocks that I was short. If I did not have that, then, well, it would have just been, I would have gone down on my long positions and held on because I knew what I was holding. And at that point, I was holding mostly value stocks where I was making good dividends, or I was holding stocks in the mining space, which were in an uptrend. So I just saw it as a temporary opportunity to buy great stocks at a discount, and I did not panic because I also had money coming in from the short positions. So it was a easy period for me compared to the scary part was 2020 when everything went straight down. So I had a lot of explorers in that crash, and some of those stocks, I remember this one called Balmoral Resources, which went down 30% in a day. And a lot of those stocks had such huge moves. And there was this refinery stock, Valero, which went from, if memory serves me right, something like $120 to $38 in no time. So that was a scary period. Compared to that, I think the April flash crash was pretty much nothing. Like once you experience a few of these, and of course in crypto, I've experienced a lot of these. So once you see it, then you're like, yeah, that's just a bargain. You buy it and you wait for the market to clear itself.
Yeah, it's interesting because I think it's like it depends like what you trade, right? Like it's like if you traded crypto, like you've seen these things. If you trade like commodities, like I mean, shit, this happens. You know, these things happen in individual things all the time. All at once, though, that's the thing that these are the hardest things to understand as a trader, which is why I'm glad this was brought up. So for me, this is what I always call the catastrophic stop. So I always know if I get out of all of my positions immediately today in each portfolio, this isn't total across all of them, but in each portfolio, what would the drawdown be? Like, let's say, you know, I hit no exit signals and everything goes straight to its trailing stop. What would the damage be? You know, sometimes that's 20%. Sometimes towards the end of the year when you know, positions get bigger, stops are wider, not even wider, they're just there's a lot more room to move to the stop. So instead of 1% per position, towards the end of the year, if you have something running like gold and silver and so on, that can be 2%, sometimes even 3% for me as the year goes on. So, you know, this type of volatility comes in at times. So as this changes, I'm always updating it once a week. Okay, if I hit all my stop loss, I'm at 20%. If I hit everything to a stop, catastrophic stop, so to speak, that would be 30%, whatever it is. But I try to keep it under 30% at all times. So when something, because, and the reason for this is when you've been trading for a while, you get an understanding that like anything can happen. Some news flow could come out and just wipe everything out in a minute. Most of the time, this doesn't happen. Most of the time, some things go up, some things go down, especially if you're running a long, short portfolio like I do. But at the same time, it's more, you just got to be ready for it. And so if you're ready for it, it can happen. And so, like for me, a lot of those positions, like I feel like I if I remember correctly, let me go back and actually look so I can give people a right answer because I do have my spreadsheet up here. So if I'm looking at 2025 during that period, I had 3 stops get hit. So one that tells you I have very wide stops on these positions. Secondly, because of the drawdown size being small and me having like a lot of positions at the time, that also tells you that these positions are pretty small. So I take small positions, very wide stops. I understand what can happen because that's the thing. Like sometimes these shocks are so quick. Like silver shock, like that actually came right near my stop. It was I remember it being like only a few percent, maybe 3% from my stop loss. And then it bounced from that zone and really never looked back. And so this is the reason why I use very wide stops. I understand the volatility. I understand the worst case scenario most of the time while it could still hang on to an uptrend. And so if I understand all those things, I can then build the positions and the portfolio in a way that lets me take advantage of that fact. If you have any more questions, though, like feel free to ask. It's a complex subject that's kind of hard to explain. So if you want me to explain it deeper, let me
Yeah,
know.
so let's do that. So you're familiar with what happened to Paul Mulvaney during that crash. So how do you as a
I'm not
trend follower?
actually. I'm not. I follow him a lot, but I only usually look at his stuff about once a year.
Okay, so he had something like a 50% drawdown, basically went short at the very bottom and then covered all of that on the recovery. So he had a, I think 2 month drawdown of 50% or something. I have a tweet on that. I can pull that up.
Hmm. You know, Paul Mulvaney he's a trend following trader who also pyramids into and out of positions. So very interesting guy, great returns, some
So
rough
I'm
years.
just posting it here. So
Okay, cool. It's in the chat for you guys on YouTube. And if you're on Twitter, go definitely come to YouTube. I did post that on my Twitter page just a minute ago. I usually update that beforehand. Sorry, guys, it happened today. Forgot about it. So what happened to him then? So his drawdown was big, it was small. What exactly was it?
so he had a 40% down month in April, and the peak to trough went to 55% because of that.
Yeah, so this is what happens too when this is why I don't like pyramiding. Like, you have a bunch of really good winners. You are like, okay, not to mention in futures. Like in futures, like if you backtest pyramiding on like stocks or even ETFs, it's fine. Futures, it's like now you're adding insane size to things and an insane amount of leverage that you probably didn't need in the first place. Because as these positions go your direction, you're already compounding these positions as well. So, that's one way to think about it. But if you're compounding to the upside, and like that was the beginning of the year was good, 2024 was decent. So I'm sure he was pyramiding into positions. And then also, like, how do you vol adjust? Now, I don't know. He's never explained that, but some people vol adjust where then they're going to move their stop loss up. So now they're moving their stop loss into the position. So to make sure the size, like if they lose, you hit a stop in these positions, you're not going to get murdered. However, now that stop loss is too tight. Then you have an event like a Liberation Day. Everything gets stopped. Your positions are a little bit larger, so now you're getting stopped in a big way. And then you go, because you're a good trend following trader, you go, okay, well, now some of these things are shorts, so then I'm going to short these things. And then they go the other direction immediately. This is a really tough thing to navigate and understand. And this is why I really like understanding the macro, because if I understand the environment, I can really get an understanding of the way I want to be positioned going forward. Like if I saw, Liberation Day and there was all these things and it was scary, it was hard for a lot of people, but at the end of the day, it was like there was liquidity. There wasn't a scenario where money supply was tightening. It was actually loosening at the time. The dollar was down. There was a lot of reasons to be bullish around that period of time. However, the price action in a very short-term period would have told you to do the opposite. So that's why I think it's really important to just understand the macro, have these very wide stops, also having lots of positions. Now, Paul might have a lot bigger portfolio than some of us will ever run. It's very hard to say like, okay, Paul could be in like he could be shorting orange juice futures like me. It's a very liquid product. You can't have, $100 million shorting orange juice futures. You could get in and out of your positions. You might not have the ability to trade a lot of these other assets that are small, even copper. That's not a thing. If you have a very large portfolio, it's very illiquid. So some of the things that went up during that time or just bounced immediately out of those lows, he may have not had in his portfolio. So don't know his exact scenario, but that's just some ways I would think about it.
Yeah, that sounds good. And plus, I think you also have the mean reversion strategies to make sure you never have that kind of drawdown, right? So I think that's an important part of your sizing.
It is and it isn't. It's like, so I always tell people like the mean reversion stuff is cool, but it's mainly for clients. It's not like, and sorry clients if you're listening to this, but it's not for me. Like if my own personal portfolio, I don't run any of those. And I had better performance there than I had in my fund portfolio. So, if you can understand that, like, trend will always make you a lot more money than mean reversion. Mean reversion will make your drawdown smaller so you feel better about your portfolio. But in the end, it's like you're going to make a lot more money riding big trends, making that money and staying away from like things that are like, oh, I'm buying this because it's a hedge. Because really that's what mean reversion is to a trend following portfolio. It's just a hedge. Same with like let's say you're just an S&P 500 trader, you buy that, and sometimes you buy the VIX when it gets very cheap to hedge. Is that strategy gonna make you a lot of money? Fuck no, it won't. It's gonna cost you a lot of money at a lot of periods of time. You're gonna be sitting there underwater with this for a long time. Sometimes it's gonna pop. You'll make a little bit. You'll be happy about it. But most of the time, you're gonna make a lot more money just being long something or short something directly instead of trying to go in and out of things and get like really cute with the strategy. So for me, trend following is always the best way to do things. The drawdowns are really hedged by the size of the position to the catastrophic stops. Like making sure your positions are small so they have room if you have something like a Liberation Day where you're not going to get hit. I remember the portfolio, we were having a really good year. The portfolio went from 42% down to 19% very quickly. So like a lot of positions got hit pretty bad. A lot of positions were pretty close to their stop, but also understand the volatility to your stop, which I mention this all the time. Probably sounds really boring. Some people will probably turn this off the second I said that, but it's like that's the idea here. Where if you look at the chart of XLE here, and you're like, okay, I'm buying, like we talked about, buying this uptrend here. Why didn't I get stopped out here? And the reason is I understand the volatility of XLE. I want to have a stop that's wide enough to handle that type of a drawdown, because that doesn't tell me that the trend is over. Sometimes the drawdowns are bigger. Maybe this would tell me the trend is over. That's something different. But if I'm looking at something like a little wobble, giving it room to dance, like you have to do that for everything. And you definitely have to do that for news events, because there's always going to be some news event out there that's going to tell us some crazy shit that's going to make the market do things that you never thought it could do. And you're going to get stopped very quickly if you have very tight stops. So the goal here is very like small positions, very wide stops, risk management, and you can get through those type of drawdowns. So we'll move on from that, because I could beat that subject to death. I love that subject. So getting into it. Somebody also asked, and this is a good Kashop question. So nickel producers or companies processing companies that could have potential. So you've been looking at NIKL, because producer wise, that's all I know. I am trading the actual product, so I do trade nickel. I am long currently. Something I don't really write about much, because I'm not going to promote the LME, and a bunch of people get murdered by them. They also stole my positions one time. So there's a lot of stuff about the LME that I really don't like, but nickel is a great product. But there's also NIKL is the nickel ETF. There's some nickel producers. Kashop probably knows a lot more about that than me, so I'll pass this one over to him.
So the best ones are in Russia or Indonesia. So you really cannot get exposure to that space. But what you can do if you are just looking for playing nickel as a commodity is you can buy the explorers. So there are a couple of them in Canada that you can look at, and I don't own these stocks, so just take my recommendations with a pinch of salt. This is just recommendation to research. So look at Canada Nickel and look at FPX Nickel. So these are stocks that you can treat as sort of call options. If nickel explodes, then great. If it becomes a strategic commodity, then the governments, the US and Canadian governments, are going to do their best to promote companies within their country. So, like similar to what you saw with energy fuels and MP materials, you could see a surge in these nickel stocks. So, but then it's nothing guaranteed. There's nothing you can say fundamentally that yes, nickel's going to go up forever or something like that. So we'll see. But if you're treating it as call options, then that's a good way to go.
Yeah, I really think it's an interesting time where we're seeing, and this is kind of my biggest thought right now, which is like we're in a commodity war. We've heard people like Rickards and everybody on earth basically talk about the currency war that even predates Jim Rickards quite a bit. Currency wars, wars over land, wars over this, wars over that. Really, right now, we're in a situation where we have a commodity war, where we have governments going into different nations to get certain commodities. Now, once again, we've done this for many years, so I'm not saying this is new. We've done this for a long time. However, we always disguised it, going back to World War I and II, not saying that was just for commodities, but, when we did anything back in the United States, whether we went into South America, whether we went into any of these different countries, we were making the world safe for democracy. Then we get to 2001, we got to get rid of the nukes over there. We got to do this. They attacked us. These were all things that we said, and not saying like I'm not arguing what is true or what isn't true. What I'm saying is we definitely wanted oil. We definitely wanted opium. Like opium is in a lot of our drugs. Opium can be transported and used as obviously it's what makes heroin. what makes other street drugs as well. So once again, it's like then we start to see kind of what's under the surface, but they never said it out loud. Donald Trump straight went into Venezuela and was like, "We're here. We're taking the oil. Oil's going to be great. Gasoline under $2, oil under $50 a barrel." Part of me respects him just being more honest, like just like there's nothing there. But however, like we're also seeing at the same time, governments are heavily investing in these companies that are producing these materials. They're investing in mines. They're investing in mining operations. They're investing in like we all know we need more power in the United States or globally. The power grid will probably be overrun very soon. So we continue to build new ideas here, whether we're using different types of energy, producing more things like coal, which we actually are currently producing or creating more nuclear facilities for nuclear energy. Like we're doing a lot of that here. So I feel like this commodity war is probably going to continue. Look at things like in Europe, like they're paying people for aluminum cans once again. That hasn't happened since I was a kid. So we're kind of in this commodity war scenario, and I think this is going to just kind of continue to happen. So areas like nickel, any of these mining companies, I don't think they're going to stop anytime soon. And I think that's an interesting thing that we all have to kind of keep on our radar. Kashab, what do you think about that? Do you think that's like that's something that we're going to continue to see, or do you think that's going to end sometime soon?
Yeah, so I think we have gone completely from the ESG NIMBY mentality to we need all of these and we cannot outsource it to China or Africa anymore. So NIMBY, for those who don't know, stands for Not in My Backyard. And that was pretty much the US policy ever since the Clean Water Act and all these EPA and all they started getting activists. So you can still sort of see it in Alaska where a big mine is being held up because some sports fishermen are like, no, 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 this will destroy our salmon. So we cannot allow copper mining here. And this is multi-billion-dollar mine over multiple decades being held up by some fishermen. So you see this sort of thing happening in the US. And the craziest thing, I think, is the Iolite project, where there is a particular flower which grows in lithium-rich soil. So if you mine the lithium, then that flower dies. And that's not even a flower, it's called a weed, buckwheat weed. So it's just crazy the kind of things people are doing in the name of the government is doing in the name of environment, which is just hindering progress. And so what this does is it pushes companies away. So they are like, okay, there's no point looking here. We cannot get a mine permitted in the US in 20 years anyway. So what do? Well, you go to Africa where your fast track to permit is less than 2 years. And the reason is because they really need the royalties. So if gold goes to $5,000 an ounce and Zimbabwe is like, Zimbabwe has a lot of gold, they are like, well, you give us 20%, we'll fast track your mine permit. So what do companies do? Well, they go to Zimbabwe. They don't want to be in Arizona where, there is dust complaint and your mine gets shut down. So all these things are happening, which has sort of killed the US mining industry. So if you go back to 60s, 70s, US was a powerhouse in mining. And then what happened? So all these things happened over the years. The United States decided it's cheaper to outsource mining to the other parts of the world. And the other parts of the world were happy to embrace it. Now they have grown, they are resource rich, and the US is resource hungry. So what do? Well, you flip the switch and say, we have all these minerals. Why have we not exploited it? Let's go ahead and start exploiting it. So Trump is saying fast 42 permits. So he's going to fast track permits. So there was this one project in Alaska. Biden said, we will not allow you to build an access road to go to your project. Trump is like, build the road. It's as simple as that. So once these things happen, then you're going to see the US take more control of its resources. You're going to see the smelters come back. You're going to see, because that's the thing, it's not important just to mine. So take rare earths. You can mine all the rare earths you want, but where do you need to send it for processing? Well, you need to send it to China. So now if you bring the processing capacity back and you bring the mines online, then you become an industrial powerhouse again. And that's something that Trump has said he wants. And if you look at the Western United States, that's something that the people want. So I think it's going to happen. It's going to reverse a long trend of ESG and NIMBY mentality killing the mining industry. So This is a multi-decade trend. I don't know how you play it, but I don't think it's a flash in the pan. I think this is going to continue.
It's interesting. I mean, it's just a it's just something that hasn't happened in many years. But I want to get to gold, speaking about mining operations and so on. Before we have to go, gold is finally breaking out of this massive base against the S&P 500. You know, we've had a couple of it getting up here and coming back down. We'll see if it gets a monthly close this month up here. Got a long time to go to see it, but however, we're peaking out right here just a little bit. So, you know, my question here is, and this is a question on a lot of people's minds, Kashop, should we still be invested in gold? Like, is the gold miners, do they have more room to run? Or do we think that this trend is done and it's time to get back to the S&P 500, buy the Mag 7, and go retire on a beach? What do you think?
So it's definitely gold. So if you look at the previous bull market, and not all bull markets aren't alike, of course, but it sort of gives you an idea of how investors thought, how investors behaved. So 2000 gold bottoms, and the United Kingdom is like, we are going to sell all our gold. So they called it the brown bottom because the Gordon Brown made that decision. So since that time, it has just been up and up and up every single year until the 2008 crisis. And even in the 2008 crisis, it was still the best performing asset. And after that, when the Fed started QE, it just rose all the way until the 2011 top. And 2012, gold still had an up year. It was just 2013, 14, 15, which was sort of bad years. But the drawdown, if you look at it, it wasn't really all that bad in the bigger scheme of things. So after that, it's been a bull market, and this bull market has been a very frustrating bull market for the gold bulls. So if you had bought gold in December 2015, which was pretty much the very bottom, I think $1,100 an ounce, by 2018, you weren't too happy with your returns because everything else had done so much better. And go to 2020, it looked like gold would pick up, and then Bitcoin, crypto, they stole the show. So it has been a very, very frustrating period, and this started to change in 2024. Now, if you have had a long bear market and a long period of underperformance, and then you finally have an explosive uptrend, the chances are that uptrend is going to continue. And here's the thing in terms of looking at parabolic moves. So you do not get parabolic up moves during a downtrend. You get them during an uptrend. Now, the early stages of an uptrend, you'll probably see a lot more parabolic moves, and then it gets a little mature. And the fact that we are seeing this tells me that we are in the early stages of the uptrend. So we probably have 2-3 more parabolic moves before we get into a lower rate of change in terms of how high the price goes. So you're not going to get 50-40% up years. You're probably going to get 20-30% up years, and then people will start thinking that's the norm. So I think we still have maybe a couple of great years left, and then we have a lot of good years left.
Yeah, I think if we're looking at gold, I think it's a very significant thing to pay attention to here for traders, which is, you know, this is the hardest thing to do as a trader, which is do nothing. You know, like everybody is asking the question, what should I do with these gold miners? Nothing. They're working, they're in an uptrend. Don't do a damn thing. Sit on your hands, go on vacation, do anything that can make you not sell these things. You know, like whatever it is. I don't care what it is. Try to do something different. Because if you're looking at things like gold miners, gold, silver miners, palladium, palladium and platinum miners, they have room to run here. And we've seen these cycles. Stop loss and chill. Yep, perfect. So if we're looking at this huge uptrend here, like it was like, what should we have done during 2000 all the way to 2011? Probably less. I don't know what exactly you should have done, but probably less than what people did. You could have just hung out in that uptrend. It was very low volatility basically till 2008. We had a bit of a drawdown, a bit of chop around, and then it just went right back up. Was the outperformer in 2009, probably 2011, or all the way to 2011 as well. And so we saw this massive peak here. What was there to do? Nothing. And then when you start to see the relative strength start to change, when you get this breakdown here, you know, you could draw a line and say it's a breakdown. You could just say this is a, you know, 12-month low, which is probably true. Whatever it is, however you look at markets, that's fine. But you start to get the breakdown, then you start to change your positioning, change your trend. You're never going to catch it right here. And we all try to do it. We all want to do it, but you're never going to do that. So it's like here, I don't know if this ends up back here. I don't know if it stops right here. But I know that if I take the position, you know, if gold is at, let's say, $2,000, you bought the breakout or you bought like a little bit before, whatever, you basically got to just ride this wave all the way up. So you're riding the wave, you're riding the wave. There's a million times you could have been like, oh, this is it, this is the end, and got out. You could have done that here, 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 anywhere. You know, this is a relative chart. Gold obviously looks a lot different than this and even better. But relative wise, you could look at it and say, okay, this should have stopped here. This should have stopped here. And you could have kept getting out of this trend. And really, in the end of the day, it's like, nobody knows where the hell this ends up. It could end up all the way up here. You know, that famous line from Wolf of Wall Street. I don't care if it's Warren Buffett or Jimmy Buffett. Nobody knows where this shit's going to go. And that's the damn truth. I have no idea where this ends up. It could end up all the way back up here once again. It could stop right here. However, the probabilities are up to the upside still. So don't do too much here. Don't overthink it. The only thing I'm doing is moving, you know, buying new positions in things like base metals, buying new positions in things like energy if it happens, buying new positions in things like uranium stocks. There's plenty of things to buy here, but there's also plenty of things to not sell. And I think gold fits in that not sell category still. So, all right, guys, we're almost out of time. I got to run. Kashop, thank you for so much for hanging out, man. Always fun. We'll be on here on Friday at 10 a.m. next week. And so we'll see you guys then.
Thanks, Jason. Thanks, everyone.